Our next guest believes the street is mostly wrong about the Fed's next move. Paul McCulley is Pimco's former chief economist. He now teaches at Georgetown's McDonough School of Business. Paul, great to have you with us. Wrong in predicting 25 basis points at the next meeting?
I think the Fed's going to be on hold at the next meeting. So I disagree with where the Fed funds futures are priced. And I don't think that the street at large, my old economic community, is convinced there's 70% odds. That's where the marketplace is. I think we're having a very lively debate in the community. And I think we're having a very lively debate at the Fed. And I think that President Goolsby's speech this afternoon was absolutely marvelous and framed where the debate will be going into May 3rd.
So if they pause at this next meeting in May, does that pull forward a pivot meaning a cut?
Yes, it does. It will be pause and then a pivot. I think the last hike back on the 22nd of last month will prove to be the last hike, but they certainly would not be declaring that at this stage of the game. They will be declaring essentially, I think, that they're going to pause and they're going to look at the data coming in, recognizing that what's going on with the stress in the banking system is going to work in tandem with what they've already done with 500 basis points worth of tightening almost. So I don't think there will be a table-pounding declaration that this thing is over at the next meeting, but unambiguously, I think there should be a pause. And I think that as we move out in the next week or two, that the street will move in that direction from the standpoint of pricing the odds.
Paul, it's Karen. Thanks for being on. So if you're right, let's say they pause and they have this somewhat dovish, and we'll look at the data kind of take on where we stand right now. Where do you think things need to be in terms of the CPI or unemployment for them to actually pivot and cut?
I think you need to have continued disinflation in order to get the pivot. And I think you're going to get that. And I think also that we need to see some more softening in the labor market. We've already seen a slowdown from where we were. We're seeing deceleration in the wage sides. So I would basically say more of the same, both on the disinflation that's in train and also the deceleration in the labor market. Just more of the same for another 3 to 6 months, I think, is the raw material of them pivoting. Because remember, we're starting from a standpoint of an inverted yield curve, a deeply inverted yield curve, and that in itself has profound negative pressure on the banking system. So essentially, all of the parts are coming together in a pause and then a pivot. So you don't need to have a recession or another run, which I don't think that we will get. You just need to have more of what's in train, and the train move down the line another 3 to 6 months.